Disclaimer. You're about to watch someone you know lose their home. Not because they were reckless, not because they skipped payments, and not because they made some obvious mistake, but because they believed the story they were told about safety, stability, and how this system was supposed to work. Right now, while you're listening to this, a pressure buildup inside the housing market is growing so large that it doesn't explode loudly at first, because it never does. Instead, it fractures silently, leaking through balance sheets, contracts, and institutions long before it ever reaches neighborhoods, streets, or front doors. And by the time it becomes visible to the public, the damage is already locked in. Here is the number that should stop you cold. Roughly 2/3 of the average American HUS net worth sits in one place, their home, a single asset tied to one assumption and one system. And if that system fails, it doesn't bruise wealth or dent confidence. It erases years of work in a way that feels sudden only because the warning signs were ignored. What you're about to hear won't dominate the evening news, not because it's secret, but because it's uncomfortable, because the pattern is too clear, the math too unforgiving, and the outcome too familiar to those who have studied how these cycles actually end, which is why it has already happened before, under different names, different eras, and different excuses, always with the same result. What's unfolding now isn't chaos, it's choreography. Because large institutions don't panic when conditions change. They reposition, they reduce exposure quietly, they move risk out of sight. And losses don't arrive as headlines at first. They arrive as footnotes, revisions, temporary adjustments, and technical explanations that no one translates into plain language for the public. While this happens, the public is still celebrating price charts, still anchoring to peak valuations, still assuming that because nothing dramatic has happened yet, nothing dramatic can happen at all. And by the time this cycle finishes, millions of people will realize something terrifying. The asset they believed made them safe is the very thing that trapped them. To understand why, you have to understand how financial collapses actually happen, not the simplified version taught in textbooks or summarized in documentaries, but the real version that plays out in balance sheets and behavior long before prices collapse. Every major financial implosion follows the same structure. The names change, the technology evolves, the language gets updated, but the mechanics never do, and it always begins with the same illusion. Asset prices rise steadily, credit becomes effortless. Borrowing feels normal instead of dangerous, and debt stops feeling like leverage and starts feeling like income. Until people no longer feel reckless or speculative, they feel smart, justified, and ahead of everyone else. This is the phase where neighbors refinance to fund lifestyles, where buyers stretch just a little further because prices always go up, and where lenders approve loans, not because borrowers are strong, but because collateral prices look inflated enough to absorb mistakes, making the entire system feel stable, deserved, and permanent. But it isn't prosperity, it's leverage disguised as prosperity, and borrowed optimism always feels permanent right up until the moment someone asks to be paid back. Then the second phase begins, and this is where most people get trapped. Because prices haven't fallen yet, headlines still sound positive, experts still talk about soft landings and resilient consumers, and most people assume the danger is past or never existed at all. Beneath the surface, however, behavior starts to change in ways that don't show up on price charts, as executives reduce exposure, institutions sell selectively, and risk doesn't disappear but migrates, moving quietly from strong hands to weak ones. This is when insiders stop accumulating and start distributing, not loudly or emotionally, but through filings, restructurings, and balance sheet decisions that don't attract attention because prices haven't collapsed yet, which is precisely why this phase is so dangerous. High prices combined with tightening conditions don't signal strength, they signal fragility, like tension building in a stretched cable where the longer it holds, the more violent the snap will be. When that snap comes, it never arrives where people expect, because the trigger is never the obvious threat dominating headlines. It's always something dismissed as manageable, contained, or too small to matter until it spreads. The trigger doesn't create the collapse. It exposes leverage that already existed, breaking a link in a chain that was stretched too far. And once that link breaks, confidence evaporates instantly. Time compresses. What took years to inflate unwinds in weeks. Forced selling accelerates losses. Liquidity disappears, and prices stop reflecting value and start reflecting urgency. A home is no longer worth what an algorithm estimated last quarter. It's worth what a buyer with financing, if one exists at all, is willing to pay under pressure, and that number is always lower than people expect. This isn't theory, it's history, and most people misunderstand that history. The Great Depression didn't begin with a stock market crash. Years before Wall Street collapsed, land speculation had already imploded, property was flipped, sight unseen, debt stacked on debt, and optimism replaced analysis. So when reality intervened, the losses didn't stay local, they flowed outward into banks, credit systems, and balance sheets across the country. By the time stocks crashed, the damage was already systemic, which is why the crash wasn't the cause, it was the confirmation. The same blindness repeated decades later when institutions once considered boring were suddenly allowed to chase yield, financing empty buildings, speculative developments, and projects that only worked if prices never stopped rising. Warnings existed, regulators understood the instability, but nothing meaningful was done, not because leaders were ignorant, but because they feared panic more than collapse. And when the system finally failed, institutions vanished, loans were sold, terms changed, and foreclosures surged. People who did nothing wrong paid the price because the structure they relied on failed. Then came the collapse everyone remembers, though even that story is misunderstood because it didn't begin with irresponsible borrowers. It began with leverage rules that allowed institutions to gamble far more than they could survive losing. Debt was repackaged, mislabeled, and sold as safety. Risk was disguised as innovation. And when the illusion broke, millions lost homes not because they were reckless, but because the system was designed to fail asymmetrically, protecting profits while socializing losses. The response wasn't reform, it was expansion. More debt, lower rates, bigger bubbles, and the core problem wasn't fixed, it was deferred. Which brings us to now. The last few years weren't a recovery, they were an amplification. As ultra-low rates pulled demand forward, asset prices detached from income and ownership became unaffordable, even as valuations soared. Households didn't suddenly become irresponsible. The math simply stopped working. Affordability didn't stretch. It broke. Quietly, we've entered the most dangerous phase again, where credit conditions tighten beneath the surface, certain assets lose liquidity, and financial instruments tied to real estate begin showing early stress. What matters isn't any single statistic. It's convergence. Commercial losses weaken banks. Weaker banks tighten lending. Tight lending suffocates housing demand. And falling prices erase equity, not as isolated events, but as connected gears in the same machine. The most dangerous gear, the one almost no one watches, sits inside financial contracts where promises stack on promises, functioning perfectly until one participant can't pay. And when that happens, trust vanishes instantly. That's how collapses accelerate, and the first visible cracks have already appeared. What comes next doesn't unfold over decades. It unfolds over quarters. And once it starts, it doesn't ask permission. What most people never realize is that markets don't collapse when everyone is afraid. They collapse when people are still calm, still hopeful, still convinced that whatever cracks are appearing can be patched over with time, liquidity, or reassurance. And that's exactly where real danger lives. Right now, the system isn't screaming, it's whispering. And whispers are easy to ignore when prices remain elevated and memories of the last crisis feel distant. But beneath the surface, the machinery that allows housing to function smoothly is losing lubrication as credit tightens unevenly. Liquidity thins in places most people never think to look, and stress gets absorbed quietly layer by layer. This is how it always begins because the first real pressure never hits homeowners directly. It hits the institutions sitting between borrowers and money. And banks don't fail because of one bad loan, they fail when too many assumptions break at the same time. Commercial properties reveal this perfectly because buildings financed under the belief that rents would rise forever now face a world where tenants have leverage instead of landlords, office space remains empty, retail traffic never fully recovers, and multifamily rents hit affordability. Ceilings tenants simply can't cross. Loans written years ago are now coming due, and refinancing them requires low rates and high valuations. At the same time, two conditions that no longer coexist. So when borrowers can't refinance defaults, rise banks take losses, and once banks take losses, they pull back. That pullback never stays contained because banks don't say they're only worried about one asset class. They say they need to protect capital. And the fastest way to protect capital is to stop lending, which quietly tightens mortgage approvals, lowers appraisals, raises down payment requirements, and eliminates loan programs without announcements. Buyers don't disappear overnight. They fail qualification one by one, and that's when prices start slipping. Not because sellers want less, but because buyers literally can't pay more. Housing prices don't fall because people change their minds. They fall because the pool of qualified buyers shrinks. And because housing is always priced at the margin, it only takes a small drop in demand to break the illusion of stability. Once price cuts begin, psychology shifts faster than fundamentals. Sellers stop thinking about upside and start thinking about exit. And at the same time, consumer stress builds in places hardest to see, as mortgage payments remain the last thing people stop paying while credit cards stretch, auto payments slide, and savings drain. This is where denial becomes strongest, because people point to low foreclosure numbers as proof of safety, forgetting that foreclosures always lag reality, and that the real damage occurs long before the data confirms it. As unsecured debt deteriorates, banks lose confidence in consumers as a whole. That loss of confidence feeds directly back into mortgage underwriting, and even people with solid jobs and decent credit suddenly find doors closing. No credit means no buyers. No buyers means sellers compete, and competition pushes prices lower. That's when the equity illusion shatters. Because on paper, homeowners look wealthy, but in reality, much of that wealth only exists as long as prices don't fall. And for millions of recent buyers, equity is thin, fragile, and easily erased. When prices fall 10 or 15%, a psychological line is crossed. Homeowners stop feeling like owners building wealth and start feeling like renters with debt. Behavior shifts, renovations pause, upgrades stop, and long-term plans collapse into short-term survival. Layoffs always follow credit tightening, and when they arrive, defaults rise, not because people are irresponsible, but because the math stops working. While foreclosures accumulate slowly, each one resetting expectations lower and becoming a new comparable sale that drags the market down. Then the sellers that truly matter step in, and they aren't families, they're institutions. Corporate investors don't hold through downturns. They rebalance, liquidate, and protect liquidity at all costs. And when large holders decide to exit, they sell quickly and in size, resetting prices for entire neighborhoods. Hot markets fall first, they always do, and places that rose the fastest don't drift downward, they drop, while buyers vanish completely, waiting for better prices that only make prices worse. Behind all of this sits the most dangerous structure of all, a web of financial contracts most people never hear about, including interest rate swaps, credit protection, and structured hedges layered on top of debt, designed to spread risk, but in reality, concentrating it. These instruments rely on trust and counterparties performing exactly as expected, and they function perfectly until one participant can't pay, at which point trust evaporates instantly. Banks stop trading with each other, liquidity dries up, and even healthy institutions get frozen out simply because no one wants exposure. This is how localized problems become systemic, how a housing slowdown turns into a financial crisis, and why intervention doesn't work the way people think it does. Central banks can add liquidity, lower rates, and buy assets, but they cannot force trust back into the system. Once it's gone, they can't make banks lend. If banks are scared, they can't make buyers borrow if buyers are underwater, and they can't stop prices from falling once confidence breaks. Printing money doesn't create stability, it delays recognition, and delay always comes with a cost. Because every time adjustment is postponed, the eventual correction grows larger as pressure accumulates rather than disappears. This is why timing matters. Because the process doesn't happen overnight. It unfolds in stages, fast enough to shock, but slow enough to deny, starting with quiet lending pullbacks rising defaults. No one watches shifting headlines and then price drops that move faster than expected. By the time the public agrees something is wrong, the opportunity to prepare is already gone. This isn't about panic, it's about positioning, because survival in financial resets doesn't come from guessing tops or bottoms. It comes from reducing fragility. Liquidity buys time buys options, and debt removes both. History doesn't reward optimism during leverage unwinds. It rewards flexibility, and housing collapses don't destroy wealth randomly. They transfer it from the leverage to the liquid, from the hopeful to the prepared, and from those who trusted the narrative to those who understood the structure. The math doesn't care how hard you worked. The system doesn't care what you believe. And when leverage unwinds, it always finds the weakest links. The only real question is whether you're positioned as someone forced to react or someone able to wait. Because when this breaks, it won't break politely, it will break fast. And when it does, the people who understood this before the headlines won't be panicking, they'll be watching. If this helped you see the system more clearly, make sure to like this video, subscribe to the channel, and turn on notifications. Because when cycles turn, information arrives late for most people and early for only a few, and this channel exists for the second group.